I'm Matt Bishar with NAREITWeek.com here in New York City for REITWeek 2015, NAREIT's Investor Forum. Joining me for this CEO Spotlight is Dennis Gershenson, President and CEO of Ramco-Gershenson Properties Trust. Dennis, thanks so much for joining us again.
Thank you for having me, Matt.
Now, the company had a number of small tenant lease expirations in the first quarter, which is typical for your operations. What opportunities do you see to change up the tenant mix or drive rents from that available space?
Well, with occupancy levels the way the entire industry is experiencing, our occupancy is about 95.5%. Therefore, all of a sudden, the world has changed from a time in 2009, 2010, where you were desperate for a tenant. Now we have 2, 3, and 4 people interested in our locations. Our small tenant space is about 87% occupied, but under 3,000 square feet, it's only about 83% occupied. So those are the very high rent payers. We can average in the mid to high 20s dollars per square foot. So we can really drive rental rates with that space that's available. We're also much more selective with the high occupancy rate in being able to pick and choose who the retailers are that we want to maintain, which allows us to maximize not only rental, but tenant mix. And so it's a wonderful combination of those two factors.
Now, switching from the small space to the anchors in your portfolio, what type of changes or trends are you seeing regarding your anchors?
Well, we have always been focused on a high-quality portfolio. And we're seeing many of the rewards for that as we did the first Steinmart deal in the state of Michigan, in our Rochester Hills shopping center. And recently, we've leased to both Nordstrom Rack as well as Saks Fifth Avenue off Fifth. So the anchors are truly appreciating our shopping centers, and they're paying up for that experience.
And lastly, can you talk a little bit about your company's development, redevelopment pipeline and how those moves are impacting your company?
Well, one of the primary drivers, especially in a very difficult acquisition market, is value-add improvements. And we have been averaging between $50 and $75 million a year, achieving somewhere in the vicinity of about a 10% return on new dollars invested. And obviously, that's much better of a return than we would get through an acquisition. So we're very focused at the present time on making as many value-add improvements to our centers as we can, and these opportunities continue to proliferate as we take a very hard look at our portfolio and approach those tenants who are either new to our trade area or are in secondary locations and would like to move to the primary location.
Dennis, thank you so much for joining us.
Well, thank you for having me.
For more on this and other REIT news and analysis, be sure to visit REIT.com.